want to welcome everybody to our top 10 financial planning tips for manufacturers this morning. Thank you for joining us. My name is Ben Sumner. I'm an audit partner with Danable and McKee.
I'm Mickel Pompeii. I'm a tax partner with Danable and McKee. Been with the firm about 15, 16 years.
So today I'm gonna kind of cover some of the financial reporting aspects, things to consider and think about. As I can't believe we're almost in August already of 24, but as we're heading into kind of the end of 2024, just some things to think about for you and your manufacturing companies out there. And Mickel's going to kind of cover some of the different tax incentives and credits that are out there. Really do kind of a deep dive into more of the technical side of some of the tax opportunities that are out there for you.
Right, Ben. A lot of opportunities people are missing, credits people aren't capturing, and just some planning opportunities for you that you might not be taking advantage of.
All right, so the first thing I kind of wanted to talk about is, as we're in from a financial perspective, you know, again, on the audit side, we're looking at financial reporting and kind of the general business considerations. So wanted to talk about reviewing your insurance and banking needs, specifically as it relates to banking, looking at those banking relationships that you have. You know, have you been with the same bank for a long time? Are you happy with the service that you're getting? Are you happy with all the different funding availabilities that you have out there? You know, specifically when it comes to financing, do you have enough of a limit on your line of credit out there? Are you looking at any new financings coming down the line that you may need? Any big purchases of equipment, expansions of the business that you're looking at? Are you talking to multiple banks, or are you just in general very happy with the banker that you're with now? Kind of sparking those conversations as we head into year end. It's never a bad time to speak with your banker, and looking into some of the other offerings that your bank may offer, like positive pay and fraud protections. You may not even know some of those types of products that they have available for you. ACH payments, remote deposits. Are you really taking advantage of everything that your bank or a banker provides out there that could kind of make your life easier, or maybe you're missing something that could provide some additional protection for you? And then, speaking of everybody's favorite topic right now, but interest rate management. Are you looking at where your rates are now compared to what the market is offering? Obviously, we're in kind of a position of higher interest rates right now. Looking at forecasts going forward, what are you going to need? What are the rates looking like? Hopefully, are they going to start dropping? Having those conversations with your banker. Are there opportunities out there to hedge any variable rate interest that you have? Consider refinancing some of the debt that you might have on the books if they're at a high rate. Really sparking those conversations right now. And actually, going back to banking, one other point that's not on the slide is looking at any debt covenants you may have. You know, I have this conversation with my clients a lot, and especially in manufacturing. Are your debt covenants that are out there, do those still make sense for your business? Have you had significant changes over time where you might want to revisit those covenants and talk to the banker and open that line of conversation to say, hey, maybe we're having trouble every year. You know, this covenant was set 5 years ago, 7 years ago, or something like that, and the business is much different now. That covenant is getting more difficult for us to meet for some particular reason. Maybe there's some flexibility on their end. Did I skip one?
Yep, insurance.
Okay, thank you. And then looking at your insurance needs. So reviewing your coverage limits. Have you had any changes in your operations, your payroll, the amount of payroll, the amount of employees? Do you have any new equipment that you might need to make sure is still covered under insurance? Cyber and fraud insurance coverage. This is one of those areas that a lot of businesses say, oh, I'm never going to need it. That's never going to happen to me. Well, those are famous last words, in my opinion. So, in fact, I've had a number, just a couple, 2, 3 clients in the last year that have had issues with cyber breaches or, scams that are coming through, and are holding data hostage, where you have to pay a large amount of money to free up your data. And that also causes some business interruption, which is another type of insurance you might want to consider. Also looking at life insurance policies. Do you have buy-sell agreements in place? Do you have ownership transitions that are happening? That are there new key people at the business that you may need to get covered? Just really starting those conversations now as we head towards the end of the year to get yourself kind of set up going into 2025.
Thanks, Ben. Number two, we're going to pivot over to income tax here. And are you currently taking advantage of the federal research and development tax credit? I see a lot of people that are taking advantage of it. I have a lot of manufacturers that get a significant credit here. I have a lot of returns that I review that come into my office that do not take advantage of this credit. So what is the R&D tax credit? So the R&D tax credit is a government incentive designed to reward companies for investing in innovation. Obviously makes sense. The credit was born in 1981, became permanent in 2015 due to its success in stimulating job creation and helping the U.S. become an economic leader. So the rules for the R&D tax credit can be found in Internal Revenue Code Section 41 and the related regulations. And the credit really applies to any taxpayer that incurs expenses for performing qualified research activities. So it's not just your white coats, your lab people. Manufacturers qualify for this credit all the time. So what are the benefits of the R&D tax credit? So up to 12 to 16 cents of R&D tax credit for every qualified dollar spent. There's a dollar for dollar reduction in your federal and sometimes state income tax liability. There's a reduction in your effective tax rate. It improves your cash flow. Obviously, if our taxes are lower and we can retain more cash, and improves our cash flow. And the credit can be carried forward up to 20 years if you are not able to utilize it in the year it's generated. So does your company qualify? So to qualify for the credit, you have to meet a 4-part test. You have to meet all 4 parts of this test. The first part's the elimination of uncertainty. So the activities performed to eliminate technical uncertainty about the development or improvement of a product or process. Number 2 is the process of experimentation. The activities include some process of experimentation undertaken to eliminate or resolve a technical uncertainty. Number 3, it has to be technological in nature. The process of experimentation relies on hard sciences, engineering, physics, chemistry, biology. Pretty much every manufacturer meets that.
Technological doesn't specifically mean computer-based though, right?
Exactly.
Yeah.
Exactly. In the language in Internal Revenue Code Section 41 and the related regulations is pretty broad as well. So a lot of people can fit into this box, especially manufacturers. Number 4 is the permitted purpose. So the purpose of the activity is to create a new or improved product or process. So the big thing there is improve product or process. You don't have to invent something new. You can improve the way you're doing stuff and still qualify for this credit. So what are some of the qualifying activities for manufacturers? I put a list together here. Developing new or improved products, process, or formulas. That's what we see the most. Developing prototypes or models. Applying for patents, certification testing. There's a whole list. I listed it out here. I have another slide that actually covers the excluded activities for manufacturers. So research conducted outside of the US, adaptation or duplication of existing business components, market research, testing or development, routine data collection, research related to social sciences, arts, humanities, stuff like that would not qualify for the research and development tax credit.
So who has the onus of proving whether it's a qualified activity or not? It's on the manufacturer, right?
Right,
Yeah.
right. So what expenses can be claimed for the credit? So there's really 4 types of expenses that can be claimed for the credit. The first are your wages paid to employees. So you can take 100% of the costs you're paying to employees, the wages you're paying to employees, while they're doing qualified research activities. The second are the supplies that are used and consumed in the R&D process. Again, you can take 100% of the supplies that are consumed. The third is contract research expenses paid to a third party for performing the QRAs. These you can only take at 65%. And then the fourth is something that I've seen very little. Usually the first, second, and third are the most used, in my opinion. But the fourth is basic research payments made to a qualified nonprofit organization or institution. These can be taken at 75%. So one little caveat here, starting in 2022, companies were required to amortize their R&D costs over 5 years. Prior to 2022, you could deduct those costs all in year one. So this was a significant change that began in 2022, and there's been a lot of discussion around this topic the last couple of years. So what I wanted to do is just take a quick, I wanted to take a look at a quick example here of how $100,000 in R&D expenses would look prior to 2022, and then how $100,000 in R&D expenses would look in 23 and future years. So previously, a corporate taxpayer could expense $100,000 of qualified R&D expenses all in the year that they were paid. The taxpayer would obtain an R&D credit of approximately $5,500 plus an income tax savings of $21,000. So that's the $100,000 expenses times your 21% corporate tax rate, providing a total savings of about $26,500 in that year. Starting in 2022 and future years, the same $100,000 would only yield an annual tax savings of about $7,600. So you'd have the same credit, about $5,500 in credit, but then only $2,100 in additional tax savings because you have to amortize the $100,000 over 60 months, and you cannot deduct it all in year one.
And that would be just in the initial year, right?
Yes, you
Yeah.
continue to amortize it for the full
Right.
60 months. So it is a timing difference, but essentially what's happening is you're paying tax on phantom income because you've already spent the $100,000, but you don't get the deduction for the $100,000. So it really comes down to a cash flow issue.
We've seen a lot of our manufacturing clients impacted
Absolutely,
by
absolutely.
the add back of the R&D.
Yeah, it turns into a very big cash flow issue until year 3, 4, 5, where where it kind of starts turning, where it starts turning, you're getting bigger deductions than you are for the add backs. So the biggest question I get from my clients right now are, will these provisions be ratified or amended? Because there's a lot of upset manufacturers over these provisions. So there's two things I'm looking at right now. Starting in 2024, there's a new form for the R&D, and they're actually asking for more information. They have a small business opt-out on this form for 2024. So that gives me a little hope that they might have a small business exception for this rule, maybe starting in 2024. There's also optimism among technology and manufacturing communities that Congress will enact something to change this. There's been bipartisan support to have this change because it's causing unnecessary harm on manufacturers, but I don't think we'll see anything until after the election right now.
Great. Thanks, Mickel. So number 3, going back to kind of the financial reporting side of it, we're going to talk a little bit about inventory. So in the manufacturing world, inventory is key. It's really the king. It kind of runs the whole show for the most part. And one of the big kind of aspects of inventory heading towards year end is going to be, how are you taking control of your physical inventory counting? And just some things to kind of think about as we go into the year end counting. Are you doing year end counting? Are you counting at some point during the mid year? You know, I know as an auditor, it's a big piece of the audits that we perform is observing those physical inventories. And coming out and looking at your processes, but from your perspective internally, how are you handling that physical inventory count? So are you scheduling and coordinating between teams and ensuring collaboration between departments? So, you know, you may think that the physical inventory count is solely a warehousing department concern, but it really needs to be a collaboration between warehousing, purchasing, upper management, accounting, right? All of these different departments need to be involved in the planning process, because in most cases, if you are doing a full physical count, there's going to be some freeze period or some shutdown period that's going to impact really the whole business, where no inventory movement is happening, or maybe certain sections of the warehouse are completely shut down. Reviewing your policies and procedures, setting kind of your schedule for the physical inventory, making sure everyone's on board, looking at your inventory policies, as far as how the count is being performed. Are you using tags? Are you just using a clipboard? Are you using the back of a napkin, right? Maybe solidifying some of those counting procedures, looking at cycle counting. More and more of my manufacturing clients are moving towards cycle counting. It tends to cause or reduce the disruptions of full physical will sometimes cause, allows you to focus on kind of some of the harder to count or more valuable items and count those more often, and really looking at year end to just get a full count to catch some of those maybe lower value items in there. And then looking at from a physical inventory perspective, what are you doing after your count takes place? Which I've observed a lot of inventories in my career here. Going out and doing the counts is obviously imperative, but then once the counts are taken, what are you doing after to look at any anomalies or differences? Are you just taking the counter's word for it, bringing them back to the office, having accounting make the changes in the system? Or are you doing double and triple checking on unusual variances from what your system's telling you? So your perpetual system may say, I have 1,000 units, count comes back and it says 50. I've seen manufacturing companies use thresholds. So if it's, plus or minus less than 5% of cost, they won't go out and do an investigation on that. Beyond that, they have a secondary team that comes in and audits those, not audits like me, like a financial auditor, but an internal team that may come in and audit those counts. And then looking at new technologies that could potentially provide the most accurate real-time inventory levels, looking at RFIDs or implementing a barcode system can be very helpful to maintain a more accurate perpetual inventory and could potentially reduce the effort needed if you were to do a full physical count. And then on the topic of inventory management, just some things to think about as you head towards the year end, assuming you're a December 31st year end, maybe you're a September year end, but either way, we all have year ends coming. So going through and looking at the products that you're holding in inventory, is there anything that's old or obsolete? Do you have a process for reserving against the old obsolete inventory? A lot of times we'll develop a methodology that will, take into consideration how many times a certain inventory unit is turning and take those into our estimates of obsolescence. Go out and talk, have somebody from outside of the warehouse department go out and actually talk to people in the warehouse department and see what they're seeing. Hey, what's moving here? Is there anything that's been sitting collecting dust for an unusually long time that maybe we need to make sure we're putting a specific reserve on? Then some other things to think about would be, demand forecasting, looking at seasonality. Is it possible to manage your inventory levels based more on seasonality or just-in-time inventory? Obviously, that's going to be based on the type of manufacturing that you're in. But we all know during COVID, there was a supply chain limitations, and a lot of us went out and had to buy excess inventories just so we had it ready and tied up a lot of cash flow in that. And now maybe we're starting to get back to where things are opening up a little bit more, and having those meetings with some of your suppliers to figure out, hey, this is going to be readily available. Let's reduce the amount of inventory we're holding, try to sell down some of the older stuff and free up some of that cash flow.
All right, to shift number 4, we're gonna talk about the federal work opportunity tax credit. So what is the work opportunity tax credit? It's a federal tax credit available to employers who invest in American job seekers who have consistently faced barriers to employment. So the Consolidated Appropriations Act of 2021 extended this credit until December 31st, 2025. So we have 2 more years to capture this credit. The third bullet point here, this is really my opinion, but the work opportunity credit is the most overlooked credit, I think, in the manufacturing arena. The returns that come into my office that I'm reviewing, I very rarely see this on my manufacturing clients. And on those returns, I'm sorry, and my manufacturing clients, pretty much every one of my manufacturers claims this credit. So let's talk a little bit about the work opportunity tax credit. So how is the work opportunity tax credit computed? It's a credit for employers who hire and pay wages to individuals who are certified by a local agency as being members of one of 10 targeted groups. In their first or second year of employment, they have to serve at least 120 hours to qualify. The credit's equal to 40% of up to $6,000 of qualified wages, so about a $2,400 credit, or 25% of up to $6,000 for individuals who have performed fewer than 400 hours, but at least 120 hours, I'm sorry. So you're looking at about a $2,400 credit for somebody who's working more, and about a $1,500 credit for someone who's working less. There are some other thresholds. So for qualified veterans, we can use up to $24,000 in wages. So you're looking at about a $9,600 credit per qualified veteran that you hire. And the wages for the work opportunity tax credit can't be used for other federal tax credits. So we just talked about the R&D credit. We can't use the same wages paid to the same employee for both credits. So just something to be aware of. Who meets the definition of a member of a targeted group? So here's your 10 targeted groups. Really your TANF, T-A-N-F, your qualified veteran, your ex-felons, designated community residents, vocational rehab referrals, summer youth employees. The big one I see a lot is the SNAP recipients, formerly the food stamp program. I see a lot of facilities hiring SNAP recipients to work in their manufacturing facilities. SSI recipients, long-term family assistant recipients, and qualified long-term unemployment recipients.
There's a screening process for that as well, right?
Yep, and that's what we're getting into on the very next slide. So what are the steps to claim the work opportunity tax credit? So it's pretty stringent here, and you want to make sure you're on top of these deadlines. So all new hires should fill out IRS Form 8850 on or before the day the job offer is made. So that's step one. Step two is the employer should subsequently fill out page 2 of the form and submit it to the state workforce agency for the state in which the company is operating. This is really important. This must be done within 21 days after the eligible worker begins work. If it's not done within 28 days, then the state agency will not grant the credit.
And now back to number 1, it says there has to be on or before the day the job offer is made, not the day of hire, right?
Correct.
Yeah.
Correct. So it is the job offer. And that's really when the 28-day window starts counting. So once you're certified by the SWA, the employee is considered a qualified employee. So you qualify for the credit, and then you have to wait until year end. So at year end, we determine the wages for the qualified employee and the number of hours worked. And once we have the wages and the number of hours worked, we can compute the credit, and we use IRS Form 5884 to file for the credit. So here's just a quick example of how the work opportunity credit works. We have 3 different individuals. First, we have Susan. She's a qualified veteran with service-connected disability and unemployed for at least 6 months in the prior 1-year period. So Susan made $27,000 last year. She worked 1,800 hours. 24,000 of her wages out of the 27 is eligible for the credit. Jim is a qualified veteran, unemployed for at least 4 weeks, but not less than 6 months. He made $25,000 in wages, and he worked 1,600 hours. So $6,000 of his wages are eligible for the credit. Dave is a SNAP recipient, and he made $3,000 last year and only worked 200 hours. So all of Dave's wages, $3,000, are eligible for the credit. Down below, we split them into the 2 categories. So $3,000 of Dave's wages are eligible for the 25% credit. So they're producing about a $750 credit. And then the other 2, Susan and Jim, are in the 40% bucket. So their $30,000 in wages would be multiplied by 40%, and they'd be eligible for a credit of $12,000. So you're looking at a simple scenario here. We're looking at a credit of about $12,750.
Great, thanks, Mickel. All right, number 5 is evaluate your strategic plan, your budgeting process. So the first bullet on the slide says develop business goals, strategic planning. So this is really kind of the start of this whole process. It should be, I would recommend at least on an annual basis, sitting down with key members of management, key members of departments, kind of in a big round table, and looking at kind of what the overall business goals are. And generally, you'll see this coming from the top down, from the president, the CEO, and C-level people, and pushing that down to upper management, and then that gets filtered down. But kind of having that process up front and looking at what are we looking to do? What's our goal for the next 12-month period, or maybe the next 5-year period, or even longer? Are we looking to spread into new geographic locations? Are we having trouble retaining employees? So we're trying to retain a certain percentage of employees. Are we looking to grow the top line? Are we looking to shrink the expense lines? Are we looking to grow the bottom line? You know, kind of focusing on what are those key business goals for the coming any set coming time period. This can be done through market research. It can be done through historical trends, talking to your customers, talking to your suppliers ahead of time, but also looking at evaluating potential risks and uncertainties that could disrupt your normal operations, and whether, you know, one of our business goals is to mitigate the effects of inflation, or trying to predict what's going to happen with the election coming in November. Also trying to look at things like global conflicts. Is there going to be some impact from, you know, the war over in Ukraine that could continue to hurt us, or has hurt us, and we're hoping that's going to start to ease? Or, you know, really looking at what the trends globally and domestically in the US are that could impact the business. Second step would be to quantify the financial impact of those goals. So going through a budgeting process. Obviously, we're accountants, so we're number people. And this is, you know, to us, probably the most important part of the whole thing. But looking at, you know, what are those goals that you have, and how can we tie that into financial results? So are we looking to grow our revenue in this particular geographic location 10%? Well, what do we need to do to make that happen? And then budgeting that into your annual projections. And obviously looking at things like market changes, and the other key thing when it comes to budgeting is to understand, I think I talk about this in a later slide, but understanding that the budget should not be some static thing that you set it and forget it. It needs to be really fluid and dynamic. It should be reviewed very regularly. I would recommend, if you are budgeting financially, going on a monthly basis and aggregating that up to an annual basis, and on a monthly time period, looking at how did we perform versus our monthly budget for that period. This is especially important if you are a seasonal business and you are, you know, maybe the summer months are stronger sales months historically for you. How did we perform? Do we need to pull back in certain areas if we didn't hit those budgeted goals? Top bullet point, the third point is obtaining commitment to achieve those goals, so individual performance planning. So this is really important when you're looking at kind of pulling the first two pieces together and then reflecting on how did we perform against that budget? What are we measuring success by? Are we looking at specific key performance indicators, percentage increases? Are we looking for gross profit goals, percentage or dollars? Are we looking for sales growth in geographic areas? Are we looking at, you know, shrinking certain expense areas? And who are you holding accountable for that? How are we evaluating the success or failure of that? Sorry. How are we evaluating that? And how are we kind of looking at, so we did hit our budget here, but we didn't hit it there. Are we performing some sort of a variance analysis? And are we looking at strategies to kind of overcome when maybe one month we didn't hit some of those specific budget goals? And this last slide in my section is really kind of sums everything up. So the operating budget is an integral part of the business planning process. Once you define those goals and objectives as a and the means for achieving them, the budget simply translates the strategic plan into the numbers. So like I kind of said before, the budget is kind of boiling down that strategic plan into some sort of a financial metric that you can then measure success or failure. Third bullet down, if a budgeted expenditure cannot be linked to a business strategy, the funds should not be spent. I know this sounds a little harsh maybe, but if you really boil it down to, you know, what your strategies and goals are, these are achieved in multiple ways through marketing expenditures, through employment expenditures, through new suppliers, through growing your customers. And how are you tying those costs that you're incurring to what your strategic plans are? And as I mentioned earlier, kind of the last bullet point, it's a continuous planning process. It's a continuous activity. Evaluating against budget, tweaking budgets is something that should be happening regularly throughout the year on at least, I would say, a monthly basis, in my opinion. And then kind of summarizing everything and seeing where we need to make changes moving forward into the coming years and adapting to that.
Thanks, Ben. Number 6, are we taking advantage of the New York State pass-through entity tax program? So as most of you probably know, this program was enacted in 2021. Basically as a workaround to the SALT cap that came from Trump's Tax Cut and Jobs Act. We'll get to that in later slides. But I still see a lot of manufacturers that are not taking advantage of this program. And it is extremely simple. Essentially, the company can pay your individual tax and you get a tax deduction for it. The company gets a tax deduction for it. It's really a way to get a tax deduction. If you're not in the program, you miss out on the tax deduction. So really entities that elect to be subject to the pass-through entity tax, they pay a graduated tax rate of up to 10.9% on their New York State taxable income at the entity level. The individual partners, members or shareholders, they will receive a refundable tax credit equal to that pro rata share of taxes paid by the electing entity. So the entity pays the tax, the individuals who own the company would get the credit.
This is specifically for pass-through entities like S corps, LLCs.
LLCs tax as a partnership. Yep. S corps, partnerships. Exactly.
Yeah.
So C corps obviously don't qualify. Single member LLCs who file a Schedule C, they don't qualify. So there's a planning point there is maybe think about making an S election. If you're a single member LLC, you're not eligible for the program, maybe it'll make sense to make an S election, become an S corporation, and now you are eligible for the program.
Great point.
So let's look at the tax rate schedule, just really quick. $2 million or less of taxable income, you're gonna be taxed at 6.85%. Greater than 2 million, but equal to 5 million, it goes up to 9.65, 10.3, and then, like I said, 10.9% is the maximum tax rate here. So we talked a little bit about this, but why would a taxpayer want to elect to pay a pass-through entity tax? So the PTET is intended to provide a workaround for the basically the SALT cap that was enacted by the Tax Cuts and Jobs Act of 2017. So the Tax Cuts and Jobs Act limited deductions for state and local income taxes to $10,000. So what that did is it really eliminated the deduction for high net worth individuals to deduct their state income taxes. So what the PTET does, it now effectively allows pass-through manufacturers to take a federal income tax deduction for their share of the state income taxes, which they were previously disallowed from taking. So again, this program is very, very lucrative. There's really no drawbacks of being in the program. So who qualifies? Ben and I kind of mentioned this, but eligible partnership is any partnership, including a limited liability company, treated as a partnership for income tax purposes, that has a filing requirement under 658C1 of New York State tax law and is not publicly traded. Your eligible S corporation is any New York S corp, including an LLC treated as an S corp for income tax purposes, who are taxed under 208(1)(a) of the New York tax law, and subject to the fixed dollar minimum tax under 209. Who does not qualify? Well, C corporations are not eligible. They're not a pass-through entity, so they don't qualify. And one important caveat here is while partnerships and New York S corporations qualify to make the election, they cannot pass through the PTET credit to certain partners, members, or shareholders. So these include S corporation partners of a partnership, C corporations partners of a partnership, and certain non-grantor style trusts. So just be aware before you make the election of who the owners of the company are, because you may not be able to pass through the credit. Making the election, so an eligible entity must elect into, you have to opt into the program on an annual basis. The election's irrevocable, and that the election has to be made by the manufacturer. The CPAs cannot make the election for you. If we could, it would make my life a lot easier. I wish we could make the election for you, but we can't do that. We'll guide you to get you there. We'll make sure the election is made by the due date, but we can't physically go in and do it. For the 2024 tax year, the election had to be made by March 15th of 2024. So if you haven't made the election for 24, there's nothing you can really do for 24, but put it on your calendars for March 15th, 25 to elect in for 25. Estimated tax payments and annual returns. So there are estimated tax payments that are required. They're due March 15th, June 15th, September 15th, and December 15th. And really, they're equal to 25% of the required payment, which is 90% of your current year tax or 100% of your prior year tax. The tax returns are due March 15th. There's a 6-month extension similar to your pass-through entity returns, whether you're a partnership or S corporation. Those returns are due March 15th as well. And then I get this question a lot, but what if my PTET income computes to a loss? Well, there is a return you have to file, but it's basically just a couple check boxes that said we had a loss this year, we have no income to report, no tax to pay. Claiming the credit. So claiming the credit at the individual level is pretty simple. So basically what you do is you file form IT 653, and basically this gives you a refundable credit that's reported on your individual return. Without the IT 653, New York State will not process your return. They will not give you the credit. So make sure you include the IT 653 with your return. I've seen numerous returns from outside CPAs that didn't have this on there. So I just wanted to put that caveat in there. I did put a quick example in, but for the sake of time, I think we're going a little over. We can refer back to the slides if you want to see that example. Other state considerations. So a lot of other states have followed suit with New York State, and they have their own pass-through entity tax program. So if you're operating in a multi-state environment, you want to look into some of these other states. And what I did is I put a chart together. It's basically 3 slides that lists out all the states that really have enacted these programs that are beneficial to manufacturers. So if you're in any of these states and you have significant apportionment in these states, you're doing a lot of business in these states, it would be worthwhile to take a look at these other states as well as New York to see if you can save some money, save some taxes with their pass-through entity tax program.
Yeah, and I would say if you're a pass-through entity and you are paying tax on pass-through income from that pass-through entity, and you have not elected into paying the pass-through entity tax, you're probably leaving money on the table.
Absolutely, you're absolutely leaving dollars on the table. And like I said, it's a very simple form. It's a very simple election. We work with you to get everything filed if we can't do it on your behalf. It's a no-brainer to be in this program.
Yep. Okay, so moving to number 7, and this will be relatively quick, but looking at analyzing the price of your product. So, we talked about the budgeting, we talked about the strategic plan. Inevitably, one of your strategic plan or strategic goals for the business is likely going to be driving that top line in some way and also maintaining or driving up the bottom line. So how can we do that? It really comes down to looking at your product mix that you're selling and you're manufacturing and what your customer base looks like. So number 1, do you know your costs? A lot of times we look at pricing our products as kind of a cost plus method. So if we have a certain cost and we're trying to hit a certain gross margin, we would tack that margin onto the cost, and that's what we price. But thinking about it from a different perspective and really getting your marketing department and sales departments involved, can we look at more value-based pricing? Are we leaving money on the table? Really important to do a detailed cost analysis, and look at what's driving kind of the cost for certain items, the variable costs and also the fixed costs that go into manufacturing any particular product that you're putting out there. Also understanding your competitors. Are you benchmarking against your competitors? Probably a tough proposition. How can you get that data, right? Are you a spy? You're probably not able to go and break somebody into your competitor's office and figure out what they're doing, but talk to your customers. Maybe they're willing to share information. Hey, I just got a price quote from ABC Corp and this is what they're charging me for that. And at least getting an understanding of where you fit into the market. I do a lot of construction audits as well and work with a lot of construction companies and the kind of the phrase in the construction world is that you don't want to win every bid because that means you're underpricing. You don't want to leave money on the table. It's okay to be, to be low, but the last thing you want to see is that you're leaving some large margin that the competitor next door is not willing to go that low. So really important to kind of know what your competitors are doing out there. And looking at your customers overall, what are their needs, and what does it cost us to bring on a new customer? And is it worth that over the life cycle of, if it's a 5-year or a 10-year contract we have, then it's likely going to be worth it. Is it a one-off to build some, low profitability product for them? It may not be worth it to bring on this new customer. And then looking at kind of in that same note, looking at customer profitability on an individual basis. Do you have the capability? So your finance, and we're going to talk a little bit in later slides about, financial reporting and internal reporting, but do you have the capability of looking at your biggest and your smallest customers? Can you break down your data into that granular of metrics and being able to figure out, are we making money from this customer or are we not? How good is the data you're getting out of your system? Looking at different metrics like contribution margin or gross margin. Are we hitting a break-even point? Do you even know your break-even point? Can you break that down into by a customer basis? That would require us to also look at overhead associated with certain customers or segments. Overhead would be those generally more fixed costs like depreciation or like maybe the rent on the manufacturing facility. Those would be things that you're generally going to incur whether or not you had any sales or not. So making sure that you have the capability of getting that data out of the system. And then looking at your customers overall and determining whether, and I would say probably on an annual basis, trying to see if you can build those customer relationships into, potential additional opportunities from a profitability standpoint, or if we have a low profitability customer, they order and they demand stuff that they need right away. They're not very flexible with you. Maybe you want to consider moving on from working with them. We like to say, looking at your customer base from an A, B, and a C metric, the A's would be, at the high end, and the C's would be the ones you might want to consider making some changes with or moving on from.
We do have a comment.
Okay, did you pause this? I can't click. It's not clicking.
That's fine. Do you want me to address the comment now, or do you want to wait till the end?
PTET.
Yep. Okay, so we do have a comment. It said another time electing PTET is not a good thing to do is if the owners have New York State carry forward tax credits that will last a number of years. If you pay PTET in that case, you are paying taxes you will never have refunded. So I somewhat agree with this and I somewhat disagree. The New York State pass-through entity tax credit that passes through to you is fully refundable. So if you pay the PTET, you will have that refunded, even if you don't have any tax at the individual level. I do agree that you want to look at the carry forward credits that you have and see if those carry forward credits are refundable, non-refundable, how large they are, how many years they can carry forward, how long it's going to take us to utilize those credits. So there's a lot of thought that goes into electing into the program. So like I said, I partially agree with that and I partially disagree. But there are a lot of things that go into making that decision.
Yeah, it's not really it's not an individual, it's not something that's blanket that can really go over every single scenario. Each one really needs to be looked at probably on a case by case basis.
Yes, absolutely. And that's a good conversation to have with your CPA. Jeff, can you move me forward one?
We'll just tell you because the clicker stopped working.
All right, number 8. So take advantage of the New York State credits and incentives available to specifically manufacturers. So are you taking advantage of all the credits and incentives offered to these manufacturers? I have 3 main credits that I take on all of my manufacturing returns. One is the investment tax credit, we call the ITC. One is the employment incentive credit, we call the EIC. And the other one is the real property tax credit for manufacturers. Next slide, Jill. So what is the New York State Investment Tax Credit, the ITC? So the ITC is a 4% tax credit on all qualified property placed into service during a specific tax year. So qualified property, which you utilize accelerated depreciation under Code Section 179, is not eligible for this. So if you have this type of property, you do not want to take Section 179 on this type of property. You'd rather take Section 168K bonus depreciation, which will still allow a significant portion of a depreciation deduction in year 1, but also allow you to take the credit. So what is qualified property? So qualified property is tangible property, including building and structural components of the building. And then it has to meet a couple of criteria. So that was acquired, constructed, reconstructed, or erected by the taxpayer after December 31st, 68, is depreciable under Internal Revenue Code Section 167 or 168, has a useful life of 4 years or more, that's a big one, so anything under 4 years, can't take it, was acquired by purchase under 179D, and is located in New York State and is principally used by the taxpayer in the production of goods by manufacturing. So that's the big item there is principally. What does principally mean? Principally is 50% or greater use in manufacturing. So there are a lot of things that you're purchasing on an annual basis that I think we can fit into this bucket, especially with the principally definition of 50% or greater use. So let's move on to the employee incentive credit. So what is the employee incentive credit? So it's a 1.5% to 2.5% credit based on an increased employment from a current year compared to a base year. So if the employment levels in the current year increase as compared to the base year, the taxpayer receives a credit of 1.5% to 2.5% of their ITC base. So the ITC and the EIC work together with these credits. So let's look at a quick example here. Up top, we're computing the EIC, and what we're doing is we have a base year of 2019 up top, and we have right underneath that a base year of 2018. Our current year is 2021. So we're comparing 2021 to 2019. We're comparing 2021 to 2018. If we do those two comparisons, we see that 2021 as compared to 2019 resulted in 103%. So basically a 3% increase in employment. Because we're over 100%, we have that 3% increase. We now get a credit based on our 2020 ITC that was placed in service. So in 2020, we had $529,000 of ITC placed in service. We get a credit because of the employment increase. So we're getting a $13,000 credit for that employment increase. If you look at 2018 compared to 2021, we actually have a reduction in employment, so we do not get a credit. So if you look down below, in 2019, we had almost $1.9 million of ITC placed in service. If we had a little bit more employment, we would have had a significant credit here, but because we didn't have the increase in employment, we don't get a credit. And the last one that we're going to talk about is the New York State Real Property Tax Credit for manufacturers. So this is a 20% credit on the real property taxes paid by an eligible New York State manufacturer. Okay, what's an eligible New York State manufacturer? They're subject to tax under 9A or 22. They meet the definition of a qualified New York State manufacturer. Again, that principally definition, 50% or more engaged in production of goods, processing, and assembly. And 3, they paid real property taxes on property in New York State that's owned or leased by the taxpayer. Sounds great, but New York State threw one caveat in here. Related party leases do not qualify. So what do most pass-through entities do with the real estate? They put it into an LLC. They have a related party lease, now you don't qualify. So it looks good on paper, something definitely to be aware of and to look out for, but as New York State does a lot of times, they threw in this little caveat that eliminates a number of taxpayers.
Okay, great. Thanks, Mickel. So my last slide here, or a set of slides, number 9, is probably my favorite part of my whole part of it, which is enhancing financial statement analysis. As an auditor, this is what I do primarily, is analyzing and auditing financial statements. But really what we want to talk about is, how are you looking at your own financial statements and the financial reporting that you can get out of your accounting system that you're using? So really, the big question is, how are you looking at the financial data? Are you looking at a detailed balance sheet and income statement? Are you looking at classifications of assets and liabilities? Are you looking at long-term versus short-term? I mean, I'll be perfectly honest. A lot of the internal financial statements that we see from our clients they don't spend as much time scrutinizing current versus long-term. And is this an asset, or is this a contra liability, or how should these things be classified? And sometimes that can really provide some differing results in key performance ratios and kind of analyzing that data. Are you doing an internal cash flow statement? It seems like that's the most complex, and a lot of times companies are afraid to do their own cash flow analysis because either they don't understand it or it's too hard to gather all the data. And a lot of times there is a manual component to doing a cash flow statement, but it can provide really interesting and valuable information as far as where's the cash going and where is it coming from. Our operations, are they generating cash flow for us, or are they using cash flow? Is our financing activity generating or using more cash flow, and are we using more or less on investing year over year? So things like property and equipment expansion. So some things to think about there. Are we able to get segment reporting by division, product lines, and locations out of our system? Or is everything kind of just lumped all into one category: sales, cost, bottom line? Hopefully you're breaking it down, and the more granular you can get, the more detailed data and analysis you can do on that. A lot of times different divisions within your company may want to see different types of information and reports in different ways. High-end management, the president probably isn't going to want to see, individual granular lines of expenses on every type of, SG&A expense that we have. They're going to want to see how did it move in total year over year. Looking at things like the cost of goods sold analysis that can identify certain fluctuations, or does it look like our raw materials as a percentage of revenue is up? Are we losing margin because our raw material pricing is going up? Do we need to consider changing some of our product pricing? And on the kind of in the income statement realm, how are you looking at income statements? In general, you should be looking at the current month compared to last year's current month, and looking at year-to-date data as well compared to last year, and also including budgeted amounts in there. I personally like to also look at fluctuations from last month's balance sheet to this month's balance sheet, because it can tell you what's happening month over month and whether there's something that's maybe triggering tighter cash flow that we need to consider as we're moving into the coming months or seasons. And we kind of touched on it, but key ratio analyses. What are we looking at on key ratios? How are we analyzing that data? I mean, the most basic would be a current ratio on your balance sheet, or to a quick ratio on your balance sheet, and then gross to net profit. But then diving in a little further, looking at inventory turnover. How fast are we moving our inventory? Are we at 1 or 2 turns of inventory a year? That would generally be considered, in a lot of manufacturing, very slow inventory turnover. There are some industries where some segments of the manufacturing segment that that may not be that slow, but you know, those are the sort of things that you want to look at and then adapting to that. And we talked quickly about the budget. Looking at budget to actual is incredibly important. And knowing that if you don't hit the budget penny for penny, it doesn't mean that the world's gonna end. It means that, you know, we got close. I would hope you'd be relatively close. And if you're not, looking at why not? Why were we not so close? What do we need to change? Were we a little bit too aggressive on our revenue forecasts, or were we, you know, were we thinking that inflation wasn't going to hurt us as bad and our product costs have gone up and now we need to plan ahead for that and get our sales guys involved and maybe changing some of the pricing around. So just some general considerations to think about, you know, when you're going towards year end and looking at financial reporting. And I'll kick it back to Mick for the last number 10 here.
All right, thanks, Ben. So my last item is the New York State Excelsior Job Program. So really, if you're growing or making significant capital improvements in New York State, this program is something you want to check out. The difference between this program and the credits we just covered, they're very similar credits, but the big difference is these credits are fully refundable, where the credits we just covered on my last slide, those are not fully refundable. Those can carry over to continue to offset tax, but these are fully refundable. So we have 4 different credits here that you should be aware of: the Excelsior Jobs Tax Credit, the Investment Tax Credit. They actually have a Research and Development Tax Credit for the Excelsior program, and the Excelsior Real Property Tax Credit. So the Excelsior Jobs Tax Credit, it's a credit of up to 6.85% of wages per net new job. For a qualified green project, the credit increases to 7.5% of wages for net new jobs. And the credit must be computed and approved by the New York State Empire State Development prior to claiming the credit on an annual basis. That's been the biggest hurdle that we've seen with the Excelsior program, is that New York State has been very slow to approve these credits. And to file for the credit, you need to have New York State's approval and attach it to the tax return. So something to be aware of. They have been dragging their feet here, but we're doing the best we can trying to get them to turn around these credit applications. What is the Excelsior Investment Tax Credit? So this is a credit valued at 2% of qualified investments. For qualified green projects or green chip projects, it's up to 5%. And again, the credit must be submitted to and approved by the New York State Empire State Development Agency. The Excelsior Research and Development Tax Credit. So this is a credit of up to 50% of the portion of the federal R&D tax credit that is related to the expenditures in New York State, up to 6% of R&D expenditures attributable to activities conducted in New York State. So for qualified green projects, those numbers change a little bit. So your 50% is still the same, but they bumped the 6% up to an 8%. And again, the credit must be submitted to and approved by New York State Empire State Development Agency. And the last one is the Excelsior Real Property Tax Credit. So this is the credit available to manufacturers locating in certain distressed areas. The credit is a maximum first-year credit of up to 50% of the eligible real property tax credits that you, or real property taxes that you paid, I'm sorry. And again, the credit must be approved by the New York State Empire State Development Agency prior to claiming the credit. They will deny the credit if you don't have the approval form on the tax return.
Good to know. So we did have some questions before, some comments that we covered. Please feel free to reach out. We appreciate everybody joining us here today. This was the first, I believe, right? First in a series of these webinars we're going to be holding over the next several months in different areas of, you know, accounting, financial reporting, just general business, and, you know, keep your eyes open for those. And like I said, thank you for joining us.